Welcome to This Explainer. Today, we're diving into the unique and, honestly, kind of dramatic world of cooperative financial reporting in the Philippines. I know, accounting frameworks might not sound like a blockbuster thriller at first glance, but I promise you, the story of how Philippine cooperatives got their very own rulebook is full of regulatory twists, bureaucratic pushback, and some truly fascinating problem solving. We're going to decode exactly what happened, why it happened, and what it all means today.
So let's kick things off with a pretty fundamental question. Why on earth do cooperatives even need their own accounting rules? I mean, why doesn't standard corporate accounting just do the trick? Well, it's because standard corporate frameworks are engineered to measure profit for external shareholders. Cooperatives, structurally, are optimized for member surplus and patronage. So forcing a shareholder-centric accounting framework onto a member-centric cooperative, it's literally like trying to fit a square peg into a round hole. It just doesn't work.
To unpack all of this, we've got a quick roadmap for today. First, we'll look at the co-op accounting chaos, then enter the new framework, followed by standard rules versus co-op rules, the statutory reserves, and finally, the regulatory pushback.
All right, part one, the co-op accounting chaos.
To really grasp the current framework, you gotta understand the absolute Wild West of financial reporting that was happening before 2016. Back then, Philippine cooperatives relied on this incredibly confusing mix of rules. The Cooperative Development Authority, or CDA, had previously given them a basic standard chart of accounts, the SCA. But here's the catch. The SCA was mostly just guidelines on account titles. It wasn't anywhere near detailed enough to prepare full, comprehensive financial statements. Because of this huge gap, cooperatives just started looking elsewhere. Some stuck to the SCA, some adopted the full Philippine Financial Reporting Standards, or PFRS, and others just went with the PFRS for small and medium-sized enterprises.
And, this inconsistency was the real core of the problem. Having co-ops doing their own thing caused massive headaches and confusion for accountants and external auditors alike. Without uniform guidelines, nobody was speaking the same financial language. You could easily have two very similar cooperatives reporting their financial health in completely different ways. Accountants had to take different positions depending on the client, which, as you can guess, completely undermined the transparency of the whole sector.
Which brings us to part two. Enter the new framework. So, the real turning point happened when the Cooperative Development Authority finally stepped in. After years of this pre-2015 confusion, they took decisive action. In September 2015, the CDA issued a memorandum circular introducing a brand new, tailored framework. This system was designed to finally bring some order to the chaos, and it officially became effective for financial statements ending on December 31, 2016. They even partnered with the Philippine Institute of Certified Public Accountants to run seminars and get everyone up to speed. Now, here's the crucial point. The CDA didn't just invent a completely new system out of thin air. Instead, they smartly used the PFRS for SMEs as their baseline. But, and this is a big but, they didn't adopt it word for word. They customized it. They modified specific accounting treatments so it would actually align with universally accepted cooperative principles, as well as the Philippine Cooperative Code of 2008. The result? The Philippine Financial Reporting Framework for Cooperatives, a standard custom-built to ensure total uniformity across all types of co-ops.
Now, you might be wondering, how does the CDA even have the authority to mandate these rules? Well, it all comes down to jurisdictional boundaries. See, the SEC oversees your standard stock and non-stock corporations. But the CDA possesses the exclusive administrative and control mandate over all cooperatives in the country. They have a completely distinct regulatory authority for a totally distinct type of organization.
Let's move on to part three, standard rules versus co-op rules.
What's genuinely fascinating here is how the CDA purposely deviated from standard corporate rules. Take interest income, for example. Absolutely crucial for co-ops that lend out money. Under standard PFRS corporate rules, interest income is recognized using the accrual method, meaning you record the income when it's earned, regardless of whether you've actually been paid cash yet. But under the CDA framework, interest income is recognized only when it is both earned and actually received during the period.
So why does this specific rule matter so much? Well, under CDA law, dividends are paid out to members based on the co-op's surplus. If a co-op used a standard accrual method, they could easily record a massive surplus on paper, just based on interest are owed but haven't actually collected. This cash basis rule prevents the cooperative from paying out phantom money. It protects them from draining their actual, real-world cash reserves just to pay dividends on uncollected debts. We see a very similar thing with how prior period errors are handled. Let's say you uncover an accounting mistake from 2 years ago. Standard PFRS rules tell you to go back and apply an adjustment to that specific past accounting year. You literally restate your past financials. But the CITDF framework, nope, it mandates that prior period adjustments must be taken up in the current year. You absorb the shock right now.
And the reasoning here is incredibly practical. Imagine a cooperative discovers a past error that actually meant they took a bigger loss in a previous year. If they restated that past year, their surplus drops. But remember, they already paid that surplus out to members as dividends. The human impact here is that you simply cannot go knocking on your members' doors asking them to hand back dividend money they spent a year ago. It's just not going to happen. So, taking the hit in the current year is the only realistic solution.
All right, part 4, the statutory reserves. Let's look at another totally unique feature of co-op accounting. What actually happens to the net surplus? In a regular corporation, earnings usually just sit there as retained earnings or get paid out to shareholders. But under CDA rules, earnings don't just become retained earnings. Every single peso of earnings must either be returned to members as a patronage refund or it gets cleanly allocated into 4 specific statutory funds. You've got the Reserved Fund, the Education and Training Fund, the Community Development Fund, and an Optional Fund. It is only cooperatives that present this highly specific allocation right in the distribution of their net surplus. I think it perfectly reflects their community and member-focused principles.
Which leads us right into part 5, the regulatory pushback.
Just when things seem to be perfectly resolved, we hit a bit of a bureaucratic climax. Enter at the Board of Accountancy, or the BOA. In September 2015, right around the time the CDA issued its new framework, the BOA published an article with a pretty spicy title in Accounting Updates. It asked, "Is CDA publishing its own financial reporting standards?" It was a very clear, very public reproach of the CDA's actions.
Basically, the BOA felt completely bypassed. They maintained that they weren't consulted at all on this new CDA reporting framework or the accounting standards chosen. Because of that lack of consultation, the BOA argued they weren't able to properly vet the standards external auditors should use when looking at co-op records. The CDA, on the other hand, stood their ground. Their stance was that, as a separate regulator with a totally distinct mandate, they absolutely had the authority to compel cooperatives to adopt this framework. So we end up with this very real, very clear tension between 2 regulatory bodies.
So, as we wrap up this explainer, it leaves us with some pretty big questions for the future. The CDA's framework is built on the PFRS for SMEs, right? And that's a standard that's constantly evolving. So we have to ask, will this customized framework be dynamic enough to smoothly adapt to future PFRS amendments? Or, as those accounting standards shift, will the friction between the CDA and the BOA escalate into an even larger clash over who truly dictates the rules of financial reporting? It's a fascinating regulatory balancing act, and definitely one we'll be keeping a very close eye on. Thanks so much for joining me on this deep dive.